The Federal Reserve just made a decision that is going to affect every single investor in America. It is going to affect your retirement accounts, your savings, your home value, and your future wealth. And based on what I am seeing, most people have completely misunderstood what this decision actually means. They are making moves right now that are going to cost them dearly. They are repositioning their portfolios based on assumptions that are fundamentally wrong, and they are going to look back in 5 or 10 years and wonder why they listened to the talking heads on television instead of thinking for themselves. I have been investing through Federal Reserve decisions for over 70 years. I bought my first stock in 1942 when interest rates were controlled by the government to finance World War II. I watched Paul Volcker raise rates to 20% in the early 1980s to crush inflation. I watched Alan Greenspan cut rates after every crisis, creating what people called the Greenspan put. I watched Ben Bernanke take rates to zero and keep them there for years after the financial crisis. I watched Jerome Powell navigate the pandemic with the most aggressive monetary policy in history. Through all of this, I have learned something that most investors never figure out. The Fed's decisions matter far less than people think for long-term investors, and far more than people think for speculators. If you are a speculator trying to trade around Fed announcements, you are playing a game you cannot win. If you are a long-term investor focused on owning great businesses, the Fed is mostly noise. Understanding this distinction is the key to not making expensive mistakes every time Jerome Powell steps up to a microphone. Let me tell you what the Fed actually did and what it actually means, then I will tell you what you should do about it. And I promise you, my advice is going to be very different from what you are hearing elsewhere. The Federal Reserve has been navigating one of the most difficult economic environments in decades. After keeping interest rates near zero for years following the pandemic, they raised rates aggressively to combat inflation that reached levels not seen since the 1980s. They took the federal funds rate from essentially zero to over 5% in less than 2 years. This was the fastest rate hiking cycle in modern history. Now they are trying to figure out what comes next. Do they cut rates because inflation is coming down and they want to support economic growth? Do they hold rates steady because inflation is still above their target and they do not want to declare victory too soon? Do they raise rates further because the economy is proving more resilient than expected? The latest decision reflects their attempt to balance these competing concerns, and the market has reacted as it always does, with volatility, with speculation, with endless commentary about what it all means. Here is what I want you to understand. The Federal Reserve is trying to do something impossible. They are trying to fine-tune a $15 trillion economy using a single tool, the interest rate. It is like trying to steer an aircraft carrier with a canoe paddle. Yes, the paddle has some effect, but the carrier has its own momentum, its own direction, its own massive forces that dwarf whatever the paddle can do. The economy is driven by hundreds of millions of people making billions of decisions every day. What they buy, where they work, how much they save, what they invest in. The Fed can influence some of these decisions at the margin by making borrowing cheaper or more expensive, but they cannot control them, they cannot predict them, and they certainly cannot time them with the precision that market commentators seem to expect. When people ask me what the Fed decision means for their portfolio, my first question is always the same. What is your time horizon? If your time horizon is the next week or month, the Fed decision might matter a lot. Stock prices will bounce around. Bond yields will shift. Currency values will fluctuate. Traders will make and lose fortunes trying to anticipate these moves. But if your time horizon is the next decade or longer, the Fed decision is almost irrelevant. What matters over decades is not the federal funds rate. What matters is the earning power of the businesses you own. What matters is whether those businesses can grow their profits over time. What matters is whether you paid a reasonable price for those earnings. Interest rates affect the discount rate used to value future cash flows, but they do not change the cash flows themselves. A great business is still a great business, whether rates are 2% or 7%. Let me give you some historical perspective because I think it is crucial for understanding why the Fed obsession is so misguided. In 1980, the federal funds rate was around 14%. By 1983, it had fallen to 9%. During that period, the stock market roughly doubled. People who sold because rates were high missed one of the great bull markets in history. In 2000, the federal funds rate was around 6%. Over the next 3 years, the Fed cut rates aggressively to fight the dot-com recession, eventually reaching 1%. During that period, the stock market fell by nearly 50%. People who bought because rates were falling lost half their money. In 2007, rates were around 5%. By 2009, they were near zero. During that period, we had the worst financial crisis since the Great Depression. Stocks fell over 50% despite the Fed cutting rates to zero and implementing extraordinary measures. In 2020, rates went to zero almost overnight in response to the pandemic. Over the next 2 years, even as rates stayed at zero, the market first crashed and then more than doubled. Then in 2022, rates rose sharply and stocks fell sharply. Then in 2023, rates stayed high and stocks rallied strongly. Do you see the pattern? There is no pattern. Interest rates do not predict stock market returns in any consistent way. Sometimes stocks go up when rates rise, sometimes they go down, sometimes stocks go up when rates fall, sometimes they go down. The relationship is far more complex than the simple stories you hear on financial television. What actually drives stock returns over time is earnings growth and valuation changes. If a company grows its earnings by 10% per year for a decade, and you bought it at a reasonable valuation, you are going to make money regardless of what the Fed does. If a company's earnings stagnate or decline, you are probably going to lose money regardless of how accommodative monetary policy becomes. This is why I spend approximately 0% of my time thinking about the Fed when making investment decisions. I spend my time thinking about businesses, which companies have durable competitive advantages, which companies can grow their earnings over time, which companies have honest and capable management, which companies are trading at prices that give me a margin of safety. These are the questions that determine investment success, not guessing what Jerome Powell will do at the next meeting now. I know what some of you are thinking, but Warren, interest rates affect valuations. When rates are low, stocks should be worth more because future cash flows are discounted at a lower rate. And when rates are high, stocks should be worth less. This is true in theory, and it matters at the extremes. But it matters much less than people think in practice. Here is why when interest rates change, it is usually because something else is changing too. The Fed does not raise rates for no reason. They raise rates because the economy is strong and inflation is rising. But a strong economy with rising inflation is usually good for corporate earnings. Companies can raise prices, revenues grow, profits expand. So while the discount rate is higher, the cash flows being discounted are also higher. The effects partially offset. Similarly, the Fed does not cut rates for no reason. They cut rates because the economy is weakening and they want to stimulate growth. But a weakening economy is usually bad for corporate earnings. Revenues slow, margins compress, profits fall. So while the discount rate is lower, the cash flows being discounted are also lower. Again, the effects partially offset. This is why simplistic rules like buy when rates fall and sell when rates rise do not work. The relationship between rates and stock prices is mediated by what is happening in the real economy, and the real economy is driven by forces far larger than monetary policy. Let me tell you what I actually think about when I hear about Fed decisions. I think about how it affects the businesses I own and might want to own. For banks and financial companies, interest rates matter a lot. Banks make money on the spread between what they pay depositors and what they charge borrowers. When rates rise, this spread often widens, at least initially. Banks can raise lending rates faster than they raise deposit rates. But eventually, competition for deposits forces them to pay more. And if rates rise too fast, borrowers default and loan losses mount. So the effect on banks depends on the pace and magnitude of rate changes, not just the direction. For capital, intensive businesses that rely heavily on debt financing, interest rates matter quite a bit. Real estate developers, utilities, infrastructure companies, these businesses have large debt loads, and higher rates mean higher interest expenses. But many of these businesses also have pricing power. Utilities can pass through higher costs to ratepayers. Real estate owners can raise rents. The impact depends on the specific business and competitive dynamics. For technology companies with little debt and high growth, interest rates theoretically matter because they affect the discount rate used to value future cash flows. A dollar of earnings 10 years from now is worth less today when rates are high. But in practice, the growth rate of those future earnings matters much more than the discount rate. A company growing earnings at 20% per year is going to create enormous value, regardless of whether interest rates are 3% or 6%. For consumer companies, interest rates matter mainly through their effect on consumer behavior. When rates rise, mortgage payments go up, auto loan payments go up, credit card interest compounds faster, consumers have less money to spend on other things. This can hurt companies that sell discretionary goods and services, but companies that sell necessities, things people have to buy regardless of economic conditions, are relatively insulated. This is the kind of analysis that matters, not will stocks go up or down because of the Fed decision, but how does this affect the specific businesses I own? How does it affect their competitive position? How does it affect their earnings power over the next decade? When I make this kind of analysis for our portfolio at Berkshire, I generally conclude that the Fed's actions will have modest effects that wash out over time. We own a diversified collection of businesses. Some benefit from higher rates. Some are hurt by higher rates. Some are largely indifferent. The aggregate effect is usually small compared to the fundamental earnings power of the businesses themselves. Now let me address what I think is the biggest mistake investors make around Fed decisions. They try to time the market based on monetary policy. They hear that the Fed is going to cut rates, and they rush to buy stocks because they think lower rates mean higher stock prices. Or they hear that the Fed is going to raise rates, and they rush to sell because they think higher rates mean lower stock prices. They are constantly repositioning their portfolios based on Fed expectations. This is a losing game for several reasons. First, you are competing against the smartest traders in the world who have access to better information, better technology, and more resources than you. These traders are processing Fed communications, economic data, and market signals in milliseconds. By the time you read about a Fed decision in the news, it has already been priced into the market thousands of times over. Second, even the professionals are terrible at predicting Fed actions. Look at the history of Fed funds futures, which represent the market's collective prediction of future interest rates. These predictions are wrong more often than they are, right? If the entire market cannot accurately predict what the Fed will do, what makes you think you can? Third, even if you correctly predict what the Fed will do, that does not mean you know how the market will react. The market's reaction depends not on what the Fed does, but on what the Fed does relative to expectations. If everyone expects a rate cut and the Fed delivers a rate cut, stocks might not move at all because the cut was already priced in. If everyone expects a rate cut and the Fed surprises with a hold, stocks might fall sharply. Predicting the Fed action is only half the battle. You also have to predict how expectations will evolve. Fourth, market timing means you have to be right twice. You have to know when to get out and when to get back in. If you sell because you think rates are going to rise and the market is going to fall, what is your plan for getting back in? Do you wait until rates start falling? By then, the market may have already rallied and you missed the recovery. The history of market timing is littered with people who sold at the right time but never got back in. I have been investing for over 7 decades, and I have never successfully timed the market based on Fed policy or anything else. Not once. And it is not for lack of trying in my early years. I eventually learned that my time was better spent analyzing businesses than trying to predict market movements. So what should you actually do in response to the Fed's latest decision? Here's my advice. First, do nothing. Seriously. If you have a sound investment plan based on owning quality businesses at reasonable prices, the Fed decision should not change that plan. Your plan should be robust to different interest rate environments. It should work whether rates go up or down or sideways. If your plan requires you to correctly predict Fed actions to succeed, it is not a good plan. Second, if you are going to do something, do the opposite of what your emotions tell you. When rates rise and stocks fall, your instinct is to sell. But falling prices mean higher future returns for money invested today. When rates fall and stocks rally, your instinct is to buy. But rising prices mean lower future returns. The best investors are those who can act against their emotions, buying when others are fearful and selling when others are greedy. Third, focus on what you can control. You cannot control what the Fed does. You cannot control market prices. You cannot control the economy. But you can control how much you save. You can control what you invest in. You can control how much you pay in fees and taxes. You can control your own behavior. Spend your energy on these controllable factors rather than worrying about things beyond your control. Fourth, keep some dry powder. I always try to have cash available for opportunities. When the Fed raises rates aggressively and markets fall, that often creates buying opportunities. Stocks of great companies sell at discounted prices because other investors are panicking. Having cash available lets you take advantage of these opportunities. If you are fully invested at all times, you cannot capitalize when prices become attractive. Fifth, remember that you are buying businesses, not trading pieces of paper. When I buy a stock, I am buying a share of a business. I am buying a claim on that business's future earnings. The value of that claim depends on what the business earns over time, not on what the Fed announces tomorrow. If I would be happy owning the entire business at the current price, I should be happy owning a share of it. And I should not change my mind just because interest rates move by a quarter point. Let me share some thoughts on what I am actually doing with our portfolio in the current environment. We continue to hold our core positions in wonderful businesses. Coca-Cola, American Express, Apple are wholly owned subsidiaries like Geico and BNSF Railroad. These businesses will be generating cash and creating value regardless of what the Fed does. We have no intention of selling them based on monetary policy. We are holding significant cash, over $300 billion at last count. Some people criticize us for this. They say we are missing opportunities by sitting on so much cash. But cash gives us optionality. It lets us act when others cannot. It lets us be greedy when others are fearful and in an uncertain interest rate environment. Having cash earning 5% is not so bad. Better than it was a few years ago when cash earned nothing. We are being selective about new investments. Valuations in many parts of the market remain high by historical standards. We are not finding a lot of opportunities that meet our criteria for both quality and price. So we are patient. We would rather hold cash earning a modest return than reach for investments that do not offer adequate compensation for the risks involved. We are focusing on businesses with pricing power in an environment where inflation may remain elevated and rates may stay higher for longer. Businesses that can raise prices to protect their margins are particularly valuable. Businesses that compete primarily on price, that have commodity products, that face intense competition. These businesses struggle when costs rise and they cannot pass through increases. We prefer businesses where customers do not have attractive alternatives and will pay higher prices rather than switch. We are thinking about the long term. We are not making decisions based on what we think will happen in the next quarter or the next year. We are thinking about where these businesses will be in 10 or 20 years. Will they still have competitive advantages? Will they still be generating profits? Will they still be returning cash to shareholders? If the answer is yes, short-term interest rate fluctuations are irrelevant. Now let me address something that I think is important for every investor to understand. The Fed is not your friend. and the Fed is not your enemy. The Fed is an institution trying to manage monetary policy to promote stable prices and maximum employment. Sometimes their actions will help your portfolio. Sometimes their actions will hurt your portfolio, but they are not thinking about your portfolio when they make decisions. They are thinking about the macroeconomy. Too many investors personalize the Fed. They feel betrayed when rate hikes cause stock prices to fall. They feel grateful when rate cuts cause rallies. But the Fed is not trying to make you money or take your money. They are trying to fulfill their dual mandate. Your portfolio is a tiny, irrelevant consideration in their decision making. This means you should not expect the Fed to bail you out if you make bad investment decisions. The so-called Fed put the idea that the Fed will always cut rates to support stock prices is a dangerous illusion. Yes, the Fed will act to prevent systemic financial crises, but they will not act to prevent stock prices from falling to fair value or even below. If you overpay for stocks expecting the Fed to keep prices elevated, you are taking a risk that may not be rewarded. Let me also say something about bonds, because the Fed's impact on bonds is more direct than its impact on stocks. When the Fed raises rates, new bonds are issued with higher yields. That makes existing bonds with lower yields less attractive, so their prices fall. When the Fed cuts rates, the opposite happens. This mechanical relationship is why many investors try to trade bonds around Fed decisions. But here is what I want you to understand. For long-term investors who hold bonds to maturity, changes in bond prices do not matter. You invested $1,000, you receive interest payments at maturity, you get your $1,000 back. The interim price fluctuations are irrelevant unless you sell before maturity. The yields you earn matter a lot, and those yields are set at the time you buy. If you buy a 10-year treasury yielding 4%, you are going to earn 4% per year for 10 years, regardless of what the Fed does after you buy. The Fed's future decisions will affect the prices of those bonds in the secondary market, but they will not affect the cash flows you receive if you hold to maturity. So for bond investors, the key question is not what the Fed will do next. The key question is whether current yields adequately compensate you for inflation risk, default risk, and opportunity cost. If a 10-year treasury yields 4% and you expect inflation to average 3%, your real return is only 1%. Is that adequate? If corporate bonds yield 6% but have meaningful default risk, is that spread adequate compensation? These are the questions that matter, not whether the Fed will cut by a quarter point at the next meeting. I want to conclude with some broader thoughts on investing in uncertain times, because that is what we face now. We do not know if inflation will stay elevated or fall to target. We do not know if the economy will strengthen or weaken. We do not know if the Fed will cut rates, hold rates, or even raise rates further. We do not know if markets will rally or crash. This uncertainty is uncomfortable. Humans crave certainty. We want to know what is going to happen so we can prepare for it. We want experts to tell us what to do. We want rules to follow that guarantee success. But investing does not work that way. Investing is fundamentally about making decisions under uncertainty, about committing capital today for returns that will only be known in the future, about accepting that we might be wrong and managing our portfolios accordingly. The investors who succeed are not the ones who eliminate uncertainty. That is impossible. The investors who succeed are the ones who learn to operate effectively despite uncertainty. They build portfolios that can withstand a range of outcomes. They do not bet everything on a single scenario. They maintain flexibility to adapt as conditions change. The Fed's decisions add to the uncertainty we face. But uncertainty is always present in investing. Even if you could predict with certainty what the Fed would do, you still would not know how businesses would perform, what innovations would emerge, what geopolitical events would unfold, what consumer preferences would shift. There is always more uncertainty than certainty in investing. My approach to this uncertainty has remained consistent for 7 decades. Focus on what I can understand. Buy businesses with durable competitive advantages. Pay prices that provide a margin of safety. Be patient. Do not try to predict the unpredictable. This approach has worked through periods of high rates and low rates, through periods of inflation and deflation, through periods of war and peace, through periods of crisis and calm. The Fed's latest decision does not change this approach. It does not require me to reposition my portfolio. It does not require me to make trades. It does not require me to become smarter about macroeconomics. It just requires me to keep doing what has always worked. Owning great businesses and letting them compound over time. That is my advice to you as well. Stop obsessing about the Fed. Stop trying to predict interest rates. Stop repositioning your portfolio every time Jerome Powell speaks. Instead, focus on the fundamentals. Own quality businesses at reasonable prices. Think long term. Be patient. Let compound interest work its magic. The Fed will do what the Fed will do. Markets will fluctuate, economic conditions will change, but over decades, the businesses you own will either thrive or struggle based on their own merits, not based on monetary policy. Bet on the businesses, not on the Fed. That is how wealth is built. That is how it has always been built. And that is how it will continue to be built long after Jerome Powell and I are both gone. But let me go deeper into some specific strategies that actually work in different interest rate environments, because I think practical guidance is more valuable than abstract philosophy. When interest rates are rising, as they have been, certain behaviors become more important. First, avoid companies with excessive debt. Rising rates increase interest expenses for indebted companies. A company that was comfortably servicing its debt at 3% interest rates may struggle at 6%. The debt that seemed manageable becomes a burden. Earnings get squeezed. In extreme cases, bankruptcy becomes a risk. I have always preferred companies with little or no debt precisely because it removes interest rate risk from the equation. A company with no debt does not care what interest rates do. Its earnings are not affected by changes in borrowing costs. It has flexibility to invest in growth or return capital to shareholders, regardless of the rate environment. Second, be cautious about long-duration assets. By long duration, I mean assets whose value depends heavily on cash flows far in the future. Growth stocks that pay no dividends and are valued based on earnings projected 10 or 20 years out are long-duration assets. So are long-term bonds. When rates rise, the present value of those distant cash flows falls more than the present value of near-term cash flows. This is why growth stocks got hit harder than value stocks when rates rose in 2022. You tend to prefer businesses that return cash to shareholders today, rather than promising returns far in the future. Dividends and buybacks provide concrete value. Now, they do not depend on forecasts of what the business will earn in 2030 or 2040. This preference naturally reduces my exposure to interest rate risk. Third, consider where to hold cash. When rates were near zero, holding cash was painful. You earned nothing while inflation eroded your purchasing power. But when rates rise to 5%, cash becomes an attractive asset. You can earn meaningful returns with no price risk. Treasury bills, money market funds, certificates of deposit. These instruments become viable alternatives to stocks and bonds. I have significantly increased our cash holdings as rates rose, not because I think stocks are going to crash, but because cash now offers a reasonable return while we wait for attractive investment opportunities. The opportunity cost of holding cash has fallen dramatically as rates rose. Taking advantage of this is just sensible capital allocation. When interest rates are falling, different strategies become important. First, be willing to lock in yields. When rates are high and starting to fall, locking in those high yields with longer-term bonds can be attractive. As rates fall, the bonds you bought at higher yields become more valuable, and you continue earning the higher yield while others scramble to invest at lower rates. Timing this perfectly is impossible. You never know exactly when rates will peak, But if yields are attractive relative to historical averages and you have a long time horizon, there is nothing wrong with committing capital to bonds. You do not need to wait for the perfect bottom second. Consider rate-sensitive stocks, banks, insurance companies, real estate investment trusts. These businesses are directly affected by interest rates. When rates fall, they can become more attractive. Banks see increased mortgage refinancing activity. Insurance companies see their investment portfolios gain value. Real estate values often rise as financing becomes cheaper. But be careful here. The same businesses that benefit when rates fall often struggle when rates rise. If you load up on rate-sensitive stocks because you expect rates to fall, and rates instead rise further, you will suffer losses. I prefer businesses that can prosper in any rate environment rather than betting on the direction of rates. Third, watch for excessive speculation. Falling rates often fuel speculation. When money is cheap, people borrow to invest. Asset prices get bid up beyond reasonable valuations. Bubbles form: the dot-com bubble, the housing bubble, the everything bubble of 2020. All were fueled in part by low interest rates encouraging risk-taking. When rates fall and speculation heats up, that is often a good time to become more cautious, not less. The best buying opportunities often come after periods of speculation end badly. Having cash available when bubbles burst is more valuable than participating in bubbles as they inflate. Let me also discuss how different types of investors should think about Fed policy. If you are young and accumulating wealth, Fed decisions should be almost irrelevant to you. Your biggest asset is your future earning power. The money you will save and invest over the next 30 or 40 years dwarfs whatever you have invested today. Market fluctuations driven by Fed policy are noise. What matters is that you keep saving consistently, keep investing in quality assets, and let time work in your favor. In fact, if you are young and accumulating, you should almost hope for market declines. Every dollar you invest during a decline buys more shares than it would have bought before the decline. Those extra shares will compound for decades. A market crash in your 20s or 30s can actually improve your lifetime returns if you have the discipline to keep investing through it. If you are in your peak earning years and building toward retirement, Fed decisions matter somewhat more, but still less than most people think. You should be focused on maximizing savings, minimizing taxes, and building a diversified portfolio of quality assets. The Fed's actions will affect the short-term value of your portfolio, but your long-term wealth will be determined by how much you save and what you invest in, not by interest rate fluctuations. If you are approaching retirement or already retired, Fed decisions matter more because you may need to draw on your portfolio soon. A market decline at the start of retirement, driven by Fed tightening or any other cause, can impair your portfolio in ways that affect your entire retirement. This is called sequence of returns risk, and it is one of the biggest threats to retirement security. For retirees, the solution is not to try to time the Fed. That is still a losing game. The solution is to build a portfolio that can withstand adverse outcomes. Hold cash reserves so you do not need to sell stocks during downturns. Own income-producing assets that provide cash flow regardless of market prices. Maintain flexibility to reduce spending if necessary. Have a plan for how you will respond to market declines. That does not involve panic selling. Let me share a personal philosophy that has served me well through all kinds of Fed environments. I focus on what the business is worth, not what the market says it is worth today. When I analyze a company, I try to estimate what the business would be worth to a private buyer, someone who would own the whole company and collect all its cash flows forever. This intrinsic value does not change because the Fed raised or lowered rates by a quarter point. It changes slowly over time as the business grows or shrinks, as competitive dynamics evolve, as the economic environment shifts. The stock price, by contrast, can change dramatically based on Fed announcements, investor sentiment, technical factors, and countless other influences that have nothing to do with the underlying business. The stock price is what the market says the business is worth today, but the market is often wrong, sometimes dramatically wrong. My job as an investor is to identify businesses trading below intrinsic value and buy them, then wait patiently for the market to recognize that value. Sometimes this happens quickly, sometimes it takes years, but it eventually happens because in the long run, stock prices converge to intrinsic value. The market may be irrational in the short term, but it is remarkably rational in the long term. This approach makes Fed decisions largely irrelevant to my process. The Fed might cause the stock price to fluctuate above or below intrinsic value, but it does not change the intrinsic value itself. And as long as I am focused on intrinsic value, I can ignore the noise. I want to leave you with one final thought. The financial media needs to fill airtime. Every Fed meeting becomes a major event because it gives them something to talk about. Every word Jerome Powell says gets analyzed and reanalyzed. Every market movement gets attributed to Fed policy, whether or not the connection is real. Do not confuse the amount of coverage with the amount of importance. The Fed gets enormous coverage because it is easy to cover, not because it matters more than other factors. Corporate earnings matter more for stock returns than Fed policy. Competitive dynamics matter more. Management quality matters more. Valuation matters more. But these topics are harder to cover. They require analysis rather than reaction. They do not fit neatly into a breaking news format. Turn off the financial news. Stop checking futures after Fed announcements. Stop trying to game the market based on monetary policy. Instead, spend that time analyzing businesses, reading annual reports, understanding competitive advantages, thinking about where industries are headed. This is not as exciting as trading around Fed meetings, but it is far more likely to make you wealthy over time. The investors I know who have built real fortunes over decades are not the ones who correctly predicted Fed policy. They are the ones who ignored Fed policy and focused on buying great businesses at reasonable prices. The latest Fed decision will be forgotten in a few months. The next Fed decision will generate just as much coverage and just as much anxiety. The cycle will repeat endlessly. You can choose to participate in that cycle, constantly reacting to announcements that probably do not affect your long-term wealth, or you can choose to step off the cycle and focus on what actually matters. I know what I choose. I have been choosing it for 70 years, and it has worked pretty well. My advice is that you choose the same. Ignore the noise. Focus on businesses. Think long-term. That is the path to investment success, regardless of what the Fed decides today, tomorrow, or at any meeting in the future.